Welcome to Thoughts on the Market. I am Vishy Tirupattur, Morgan Stanley's Chief Fixed Income Strategist.
And I'm Joyce Jiang, U.S. Leveraged Finance Strategist.
Today, we'll take a look at private credit markets. Will it stay resilient in the current macro conditions, or a reckoning is ahead of us? It's Tuesday, May 13th at 10 a.m. in New York. Tariffs and policy uncertainty are on the top of mind for people with an eye on the economy and markets. Certainly a frequent topic of discussion for us on this podcast. In this environment, there has been growing concern about the health of corporate credit. And within corporate credit, direct lending or middle market segments where companies tend to be smaller in size and have weaker fundamentals are of particular concern. The business models of these companies are sensitive to slower growth. Joyce, can you map out the risks associated with private credit companies?
To your point, risks are rising in private credit, but I think these risks would be measured given the still resilient fundamental backdrop. Looking at fundamental trends, there is no clear sign of leverage building up in the system yet. And multiple data sources actually show that the leverage ratios among direct lending companies have either improved or remained flat. And that's very different from the previous cycles where excessive corporate leverage set the stage for the eventual downturn. So this time around, credit, including both public credit and private credit, is not the source of the problem. But of course, these direct lending companies would be impacted by higher tariffs. So Vishy, what's your view on the tariff impact?
So the direct impact of tariffs, Joyce, we think is likely to be muted. It's quite hard to quantify this exposure, but if you look at a number of different data sources, we find that the direct lending loans are more skewed towards defensive and service-oriented sectors. For example, sectors such as technology, business services, and healthcare account for over half of the loans in typical BDC portfolios or business development company portfolios of direct lending loans. But that said, even though the direct impact could be somewhat limited, there could be second-order effects. Because there is higher uncertainty and weaker confidence, and that could weigh on demand, there could be a tail cohort that could be developing. So some data from Lincoln International, for example, shows that about 15% of direct lending companies have EBITDA interest coverage ratio below 1x. Another way of looking at tail cohort is by looking at companies generating negative free operating cash flow. According to S&P data, that's about 40%. These tail cohorts are stretched and are weakly positioned to weather macro challenges ahead. So Joyce, another thing that comes up frequently when we talk about private credit is payment in kind interest, or the so-called PIK interest. Can you walk us through what is a PIK and why is it a concern?
So payment in kind interest, it occurs when the company stops paying interest in cash, but instead the interest is accrued and added to the principal balance. It is quite common for companies under liquidity stress to switch to PIKs for cash preservation. But in many cases, PIKs don't really clean up the company's balance sheet, and the companies may still end up in a conventional default. So PIK is generally considered as a leading indicator of default by market participants. And to be clear, not all PIK loans are bad. PIK toggles are actually a key feature that distinguishes direct lending loans from syndicated loans because it provides non-distressed companies the flexibility to reallocate cash for other business needs. So PIKs do not necessarily signal higher defaults. And in fact, data show that BDCs or business development companies with a higher PIK income don't always see a greater increase in non-accruals. So in other words, the relationship between PIK income and defaults is not persistently strong.
So to summarize, the overall fundamentals are on a relatively strong footing, but risks in private credit are rising, especially if we have a potential economic slowdown ahead. On the other hand, there are a few structural features with the private credit loans that could potentially help mitigate some of the vulnerabilities we've just talked about. First thing, direct lending loans are not mark-to-market by design. So they have lower volatility and are relatively immune from daily price moves. And very related to that, redemption risk of private credit funds has been fairly contained so far. These funds usually have tools like lockup periods and redemption caps to guard against unexpected large outflows. But of course, the effectiveness of these mechanisms has not yet been tested in severe downturns. Moreover, the capital that is going into private credit is relatively sticky capital. Key investors, such as insurance companies and pension funds, are held-to-maturity type buyers, and they are entering in the space for the attractiveness of the higher yields and to harvest illiquidity premia embedded in these loans. So with that long-term investment horizon, they would be more willing to support companies through temporary liquidity challenges. Also, small lender groups in direct lending market makes it easier to negotiate restructurings.
Lastly, there is also ample dry powder. According to PitchBook, there is $570 billion of dry powder in private debt funds and another $2 trillion in private equity funds. And this capital can be deployed to backstop distressed companies and help keeping defaults in check. And in terms of defaults, we are expecting syndicated loan defaults to end the year at 4%, and that's our base case. And based on the historical relationship, that implies a like-for-like default rate for private credit at 5%, which means a mild uptick from the current level, but is still below the COVID peak.
Joyce, thanks for taking the time to talk about this.
Thanks for having me, Vishy.
And to our listeners, thank you for your attention. Let us know what you think of this podcast and the topics we cover. And if you think a friend or a colleague might find this information useful, please share Thoughts on the Market with them today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.